Yes, good morning, everybody. So, this morning we will be discussing portfolio theory. It's also an aspect under the cost of capital. If you look at the syllabus, you see it where they're asking us to compare portfolio theory and capital asset pricing model. Yes, if you take note of the syllabus, you see it there. So, discover there is need for us to look at it, even though they didn't talk about it much in the study pack as we used to have it in SFN, but questions can also be drawn from it. So when we talk about portfolio theory represents collections of several investments or several investment instruments such as bonds, stocks, shares, and other similar securities. So when you have collections of all these, you can refer to them as portfolio. Now, when you have collections of securities, bonds put together, known as portfolio, there is a tax on you as an investor to see how you can manage these, your portfolios. Yes, how you can manage these collections of your investment. So, portfolio management is the art of building and managing several investments. That is, these steps of management or process of management must be consistent with the long-term financial goals, and it must take into consideration the risk tolerance of the investors. So we've made it clear that there are various forms of risk appetite. Yes, some persons are risk averse, some are risk neutral, some are aggressive towards risk, some love risk. So portfolio theory is a theory on how risk-averse investors can construct portfolios my expected return based on a given level of risk. So portfolio theory, the assumption that invest and do not like risk. So when we talk about investors being rational, what this simply means that when you're giving an high level of risk, the investor will expect a high level of return. And where two securities have same level of return, at that point, the investor will like to select the investment with a low level of risk. So when you have two securities giving you same level of return, what will now form your level of decision will now be what is the risk associated with each of these investments. The investment with a lower risk will form the basis of your decision. So portfolio, in simple terms, is a collection of different investments that makes up an investor's total holding. So a portfolio can be investment in stock and shares by an investor, in capital projects by a company. A portfolio also is concerned with establishing guidelines, which I have mentioned, management for building up portfolios of stock and shares. So portfolio theory said is concerned with establishing guidelines for building up a portfolio of stock and shares or portfolio of projects. So this theory of portfolio uh, Okay. So this theory of portfolio, the theory of portfolio was first developed in 1952 by Harry Markowitz. So the idea behind the concept of, of portfolio is how we can reduce risk. How we can reduce risk. That is, his explanation, that is Markowitz, his explanation is hinged on the fact that how can investors reduce risk? Now, reduction of risk has to do with spreading of your investment across range of assets. So when you try to spread your risk across range of assets, that will now lead to you having portfolios of assets. It means when you have an investment in Dangote, you have an investment with Zenith Bank, you have an investment with Access Bank, you have an investment with a mining company. Now, these collections of investments, when pulled together, they are termed as portfolio. So when you base your investment just in one particular sector, it means that once there is problem in that sector, your whole investment might crash. So the concept of portfolio is how can you spread your risk? You spread your risk by having investments in the building industry, construction industry, agriculture industry, mining industry. So when there is an adverse effect on one of those industries, there will be a compensation for you in another industry. Just like the theory of not putting your egg in one basket. Yes. So it's good you spread your risk. You spread your risk. So the concept of portfolio is based on the fact that investors need to spread their investment across a range of assets, because when you spread your investment across a range of assets, when there is bad news concerning one of your company, you will be compensated with good news in another. So what Markowitz is just trying to say, Markowitz gave us tools for identifying portfolios which gives the highest return for a particular level of risk. So I didn't put down some of these things in my slide. That is why you're not seeing me moving my slide. This slide is a past slide I used, and some things that are not here. So, but the main point is this. When we're talking about portfolio, we must know what risk is all about. Risk. And we've defined risk over time in one of our classes, that risk is defined as the chance that an investment's actual return will be different than expected. What is your actual? What is your expected? So the difference between your actual and expected will result into what we call variance. Yes, and when you have variance, there is a deviation from your expectation. So in portfolio theory, once we determine variance, for us to determine risk further, there will be need for us to determine what we call standard deviation. Standard deviation. So risk is defined as a chance that an investment actual return will be different from expectation. So this includes the possibility of losing some or all of the original investment. So portfolio risk is measured by standard deviation. Portfolio risk is measured by what? Standard deviation. So when you derive your variance, you need to move further to determine what? Standard deviation. So This risk, this standard deviation can be minimized through diversification. Through diversification. So the diversification is spreading your investments across various sectors so that when there is bad news in this sector, you'll be compensated with a good news in another sector. That is, when there is a decline in returns from one sector, there should be a profit from another sector that will compensate you for the loss in the other sector. So we have types of risk. We have types of risk. If you've gone through the slide on risk and investments, I explained risk in that slide, even though we didn't talk about it in the class. So we'll be using this period to talk about that now. We have types of risk. There are basically two types of risk, and these include systematic risk and unsystematic risk. Please take note of these two terms. Is what is a recurring issue even in FM and SFM, and even in some of our discussion that will come later, is we'll be referring to systematic risk, unsystematic risk. Now, when we talk about systematic risk, what do we refer to? Systematic risk. Systematic risk is a type of risk that affects all the companies or businesses in the economy. It means the fact that your business is in Nigeria, is situated in Nigeria. Once a risk is affecting company A, it will definitely affect company B. Such risks are macro issues, macroeconomic issues that you cannot run away from, such as inflation, issues of economic recession, issues of political turmoil, political instability in the country. They are systematic risks. They are risks that are endemic in the economy. They are risks that you cannot run away from. There are risks that you cannot run away from. So this is the type of risk that affects all the companies or business in the economy. It's a kind of risk that investors will like to pay for in order to avoid. So it is also known as general or non-diversifiable risk. Can also be referred to as non-specific risk. And more so, it can be referred to as market-imposed risk. It can also be referred to as unavoidable risk, and the key point here, it can be referred to as beta risk. Beta risk. Beta, B-E-T-A. B-E-T-A. Beta risk. That is systematic risk. So I'm referring to it as beta risk because by the time we go further in our discussion, we'll be referring to beta. Beta. So when you hear beta, it is systematic risk. Systematic risk. So systematic risk cannot be eliminated through diversification. Though it can be hedged against, it means you can guide against it, but you cannot completely run away from it because it's a risk that affects every sector. Yes, every sector in an economy. So it can be caused by various events which I've mentioned. It can be caused by terrorist attacks. It can be caused by pandemic. Yes, issues of COVID-19. It can be caused by war, and so on and so forth. So, in simple terms, systematic risk entails market risk, entails interest rate risk, entails purchasing power risk, entails political risk. That is in form of war and the rest of it. So that is systematic risk. So when we talk about the other one, unsystematic risk. Based on this explanation, who can give us a clue about unsystematic risk?
Okay, so I
Unsystematic.
think there are risks that are peculiar to the business.
Okay, yes. Yes.
Okay.
That's
It can also be risks that can be avoided
yes.
or that's diversified. It can also be diversified.
All right, very well. Yes. Thank you. So unsystematic risk. This is a kind of risk that is peculiar to a particular company or industry. The fact that you are in the agri sector, once there is a risk befalling that sector, it will affect you. Once you are in the banking industry, once there's a risk affecting that industry, it will affect the whole banks operating in that particular industry. So unsystematic risk is a kind of risk that is peculiar to a particular company or industry. It is also known as specific risk. It can also be referred to as unique risk. Also, it can be referred to as non-market imposed risk. It can be referred to as avoidable risk. It can be referred to as diversifiable risk. It can be referred to as residual risk. And it can be referred to as what? Alpha risk. You know, the other one was beta risk, and this is alpha now. I believe you are used to this word alpha, beta. It's not only science students. In fact, there is a level you get to when treating SFM. You'll be asking yourself, are you a science student? As a matter of fact, you're a science student. Because if you've badged BSc in accounting, BSc in economics, you're a science student. So all this, when I was reading for SFM, it gets some points, some formulas, I would just have to neglect them because it's taking me off. It's taking me off already. So some of those things are, you need to keep proving and seeing what you can do about some of those formulas. But I don't think that is in SFM, in FM for now. When you go to SFM, you have the grace, can unravel those things. So unsystematic risk. What are those things that can cause unsystematic risk? Things like management change. When there is a change in the management of a business or the regulatory management of that particular industry. When there is a change in terms of location. When there is dependency on limited markets. So these unsystematic risks, they are risks that are just peculiar to a particular sector. So by the time we solve, we go further in cost of capital, there will be a need for us to determine project specific cost of capital. Project specific cost of capital. And in determining project specific cost of capital, there will be need for us to determine what we call proxy beta. Proxy beta. It means when you are operating in agri sector and you want to diversify to, let's say, the mining sector, you will need to go and look for the risk that businesses in that sector face. You need to determine the risks that businesses in that sector face. And once you're trying to determine that risk, that is beta risk. Hence, you now need to ungear and regear. You ungear and regear for you to be able to solve, to determine the cost of capital regarding that particular question. So when we get there, we'll see that. But some people that have been reading ahead, you might have seen that even in your study pack, talking about project specific cost of capital. So having talked about all this, portfolio diversification. Portfolio diversification. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio. I usually like to make example with these malams that sell tea, if you observe some of them, they've diversified. Instead of just selling hot tea, they are now selling cold drinks. They are now giving out indomies to people. So the implication is that when the weather is cold, there is market for tea. When the weather is hot, there is market for what? For soft drinks, chilled soft drinks. So it means that also for an organization, when you have an investment in an umbrella producing industry, and you also have an investment in a raincoat producing industry, if you look at this set of investments, you've not diversified, because once there is no rain, there will be low sales for these products, for umbrella and for raincoat. It means that for you to continually enjoy good return, you have to diversify. You have to diversify. Instead of putting your investments in one particular sector or in one particular line of business, there is need to diversify. Because when you diversify, you will not be affected by situations that may befall that sector. So diversification is a way of reducing risk. As I've earlier stated, that the risk of a security and the risk of a portfolio can be measured as a standard deviation of expected returns. And the risk of a portfolio depends only on the riskiness of the securities makeup. That is a portfolio now. So there are relationship, three forms of relationships we have to look at. We have to look at in terms of diversification. There's what we call positive correlation. Positive correlation. Right. So relationship relationship there is a pop-up on my yes. So relationship between investments can have relationship between investments in different forms. We can have positive correlation. Positive correlation. We can have negative correlation. Negative correlation. Also, we can have no correlation. No correlation. So when we talk about positive correlation, it means that two investments are going same way. This is a situation whereby both investments will always move in same direction. That is, if one investment performs well or badly, it is likely that the other investment will perform likewise. Yes, for example, as I've mentioned earlier, talking about the umbrella and the raincoat, if you buy shares in a company making umbrella and in another which sells raincoats, you would expect both companies to perform badly in dry weather condition. Yes. So with positive correlation, risk is not reduced through diversification. So because we can merely achieve average figure because both investments are moving in same direction, But where you have one investment in another sector, it means when one is going up, the other will be going down. But in this case of positive correlation, your portfolio of investment, everything is moving in one direction. Now, in the case of negative correlation, with negative correlated investment, if one investment perform well, the other will perform badly. That is negative correlation. If one investment perform well, the other will perform what? Badly, or vice versa. So if you hold shares in a company making raincoats and in another which sells ice cream, the weather will affect the companies differently, and the return of both companies will move in opposite direction. So under conditions of negative correlation, the risk on a portfolio will be less than the risk of individual constituents. That is, when you put the collections of those securities together, the risk that will befall the entire portfolio will be less. But when it is just one single investment, the risk that will befall it will be too much and it will be observable. But when you have collections of security in different sectors, there will be a shock absorber to help mitigate about the risks befalling the other. So the co-movement of the return is such that they cancelled one another. That is in the case of negative correlation. So where there is no correlation, this is where the returns in two companies are completely unrelated. They are completely unrelated. That is where the performance of one investment will be independent of how the other performs. So for example, now, let's say you hold shares in a mining company, and also you have shares in a leisure or an yes, in a leisure industry, that is hotel and the rest. It is likely that there will be no relationship between the profit and the return from each, because both are not related. This is independent, this is independent. There is no correlation between the two. So where there is correlation is whereby you have an investment in a refrigerator industry, you have an investment in in let's say in also a an oven. Yes, these are two issues now. One is refrigerating, one is giving heat, something like that. So it means when there is an increase in investment in one, there might likely be a fall, because when there is much demand for this in a particular season, there will be less demand for this in the other season. So these are some of those things we need to know. But the main point is issue of computation. The issue of computation. How do we compute issues that has to do with portfolios? With portfolios question. These are the points we need to look at now. Now,
Sir, please, can you explain this positive negative correlation, like how the two are? Is it when one is going up, the other one is going down? I didn't really understand that part.
somebody should speak to that.
I think positive correlation is as in the same type of investment, that the outcome was always the same. I think.
Okay, I said positive correlation is where investment we always move in the same direction. That is, I said, if one investment performs well, it is likely that the other investment will perform in same manner likewise. That is, I said, and I'll make an example that if you buy shares in a company making an umbrella, and you buy shares in a company selling raincoats, these two investments, they are related somehow, because when there is high demand for raincoats during rainy season, there will also be high demand for what? For umbrella. So it means both are moving in same direction. So if you have these two sets of investments in your portfolio, it is not good. It's good you diversify. Because when there is a negative occurrence on these two investments, it will affect your entire portfolio. But for your entire portfolio not to be negatively affected, spread your investment across other sectors. So we said with the positive correlation, risk is not reduced through diversification. So with positive correlation, all your investments are moving in same direction. The returns you get, maybe if you're only getting returns, high returns during dry season, during cold weather, your returns will be low. So what you should diversify to a point whereby when there is less return during dry season, there should be an investment that will give you more return during that period. And when there is less return during rainy season, there should be an investment that will compensate for that less return during rainy season, that will give you more income, more revenue. So for negative correlation, I said with negative correlation, if one investment performs well, the other will perform badly, or vice versa. So that is you diversifying your portfolio. I make an example with the issue of raincoats and ice cream, because raincoats is the sales for raincoats will be more during rainy season. The sales for ice cream will be more during where? Dry season. It means when one is going up, the other is going down. This is negative relationship, negative correlation. So
Okay, sir. Thank you.
So talking about the computation parts of this, some things we need to know. Let me go back to my slide now. I think so. Majorly, we try to see how we measure risk. We compute for risk.
Ahmed.
So we see how we measure risk. And now one of the way we measure risk is through variance. Variance. And for you to measure variance, it is the summation of probability. The P there is probability, as you can see in the screen, in relation to the amount of return. You'll be given expected return in the question, and we have also the return less the R bar. The R bar is what? The average expected return on the investment. So this is the expected value of the return. So for you to get variance, you'll be expected to determine the summation of your R and also the summation of your R bar. When you determine your variance, the square root of that variance will now give you your standard deviation. It means you can determine your variance by using the formula above, where we have P, which is the probability of the various outcomes, probability of various outcome. You will be given the expected return, and you'll be required to determine the variance, the deviation. Yes, the variance. So for you to determine your expected return, you need the formula approach, the formula above, rather, the formula above. So we can have a case of single investment. We can have a case of multiple investment. So when you have single investment, it is very easy to compute. You use the above formula. I think I have another one. Let me go and show that. Yes, this is it for individual securities. You can see for individual securities, you use this to determine variance. Now, when you determine variance, the square root of the variance will give you standard deviation. This is it. This symbol is for standard deviation. But first, you'll be required to determine variance. Once you determine your variance, then you move further to determine what? Your standard deviation. And also, when you have two assets or two asset portfolio, we use this formula to solve. Hope this is not scary, please.
So it's much.
Okay, Papa, thank you for asking.
Now wow.
This one,
That is
I hope all this formula will be given the exam, Sha. Because how many formula I want to cram now? Hey, God have been
They are in the question paper. They will give it to you in the question paper.
better. Oh.
most time the formula you will know is different from the one in the question paper.
Yes, me,
So I,
don't be scared by the formula. By the time you keep solving and solving, me, I don't usually assume there is formula in the question paper. I just try to see how I can, and that is why I want to treat all this so that you get used to them very fast. Not during exams or 2 weeks to exam, you are struggling to see how you can unravel certain things. So that is why we need to do all this before the exam. At least you still have time now. So this shouldn't scare you. But I think it's in the question paper. Yes, in the question paper. So for two asset portfolio, we use these formulas you can see. And in the formula, P is probability. Yes, for you to get the standard deviation, P is the probability, and X. These formulas is nothing big there. The two portfolio, the two assets is asset X and asset what? Y. Asset X and asset what? Y. Now, X is the return on security X. X is the return on security X, and Y is the return on security Y. This WX now is the weight proportion. That is the proportion. If security X is 60%, security Y will be what? 40%. The weight, that is this WX, that is weight or proportion of amount invested on security X. That is WX. So it's nothing, there is no any big issue with that. And for WY, it is the weight or proportion of the amount invested on security Y. We're going to solve an example, then you see what I'm talking about. Then for this is the standard deviation of security X, standard deviation of security Y. And for this, it is your results at this point. That is a covariance. Yes, the covariance. Your result at this point, 2 multiplied by this result at this point. Now, in some of your books, I think in the study pack, instead of having x to the power of 2, y to the power of 2, or x to the power of 2 here, what they've done is outside the bracket, they just put 2. Take note, it's still the same results. Don't get confused. Instead of having x to the power of 2 here, standard deviation x to the power of 2, outside the bracket, they just put 2. The bracket, everything to the power of 2. You still get same result. That is the same thing they've done I think I was going through the study pack to make sure that all I'll be saying is in line with the study pack. So this is covariance. It is 2 multiplied by the weight of security X and standard deviation of security X, 2 multiplied by the weight of security Y, multiplied by standard deviation of security X. So this Rx and Y, it is the correlation coefficient between security X and Y. I believe some of you have done projects. Some of this terminology should not be strange. If you've not given somebody your project work to do for you in school, in statistics, they usually teach correlation.
Yes.
They'll teach linear regression. Yes. So, but most people don't like writing their projects. They'll be looking for people to do it for them. So once you've done those things, some of these things will not be strange to you. So, but please, let's take note. In exams, when the given probabilities of 2 securities are different, maybe we have security X and Y, and the probabilities are not correlating, they are not same. When they are different, it means that there is no relationship between the 2 securities. It means that this Rx and Y, which I said is correlation coefficient between 2 securities, will be 0. Will be 0. Will be 0 when the probabilities of security X and Y are 2 different things. Instead of having 0, 1 for X and Y, you're having 0, 1 for X, for Y, you're having 0, 2. In that order, it shows that they are not related, they are not correlated. So in that instance, this point, Rx and Y, will be 0 because there is no relationship between the 2 securities. Between the 2 securities. So now, there is this simple example I want us to solve to determine variance. Variance. The example is in the study pack. Yes. Before I come up with my own, I think I have another question here. Yes. So, but let's pick this example to determine variance. Then we'll move further to determine deviation. Then we'll take it further to determine issues of multiple securities. That question I sent on the platform is a combination of multiple portfolios, multiple securities. So I want everybody to have access to it. It might not be clear on my slide. That is why I forwarded it to the WhatsApp group. But let's build it up. So we have this example. Example that's from the table below. Compute the expected return. Compute the expected return. Variance and standard deviation. Standard deviation. Let's have the table now. So we have states. States. We have probability. And also we have expected return. Expected return. So we can have a state of expansion. Expansion can have a state of normal, can have a state of recession. So the probability when there is expansion is 0.25. Probability when it is normal is 0.5. And the probability in terms of recession is 0.25. The expected return, this is your expectation. If there is anything contrary to this, it means there is variance. The expectation is 5% return when we have expansion. The expectation is 15% when it is normal. The expectation is 25% return when it is recession. So now, for us to determine our expected return, what are we going to do from our previous knowledge? For you to determine expected return, what are you going to do from the previous knowledge?
And the probability
You
multiplied
multiply
expected
the
return.
probability
It's
by
simple.
the
Yes.
Okay. I think this is okay. You multiply the probability by it should be return, yes. So the expected return will be what? Expected return will be what? The probability 0.25 multiplied by 5% will give us what?
0.0125.
0.0125. 0.0125. Okay. All right. So for this, it will be what?
0.075.
0.075. And for this,
Zero point zero six two five.
0.0625. 0.0625. Now, the total expected return will be what? The total expected return will be what?
0.15.
0.15. So, in percentage, it will be what?
15%.
15%.
So, for you to get the variance, what are we going to do now? From the formula we've shown, we said is what? P. From the formula,
Yes.
we can present it this way. Let me just write it. It's P into the bracket of what? P into the bracket.
R minus R square bracket
Okay, R
close.
minus R square. It can,
Amane. Aba.
yes, R bar. Yes, R
All
bar.
square.
Yes, all squared. And it can also be expressed as the way we know it in our normal statistics as P into the bracket of X minus X bar, everything
Extra.
square.
All square.
So in this case now, what is your R bar or what is your X bar? This is our R bar. This result here, this 15% is our R bar or
Expected
X bar.
return.
Yes, so R bar. Please, if you are writing, write it well. I can't get some of those functions to do the R bar and the rest. So this is not just R now, it is R bar, please. R bar. So everything squared. Everything squared. So for you to get your variance, you need this. You need this. So in this regard now, your probability is what?
0.25.
The value of R is what?
5%.
0.05.
Okay, 0.05. You can work in that way, or you can work by writing just 5. 0.05.
But if you write
So
5, will you also write 0.25 like that?
0.25. Yes, that is already in probability, yes.
Probability. Okay. But if you write 5, you write 15% then.
Yes, if you write 5, you write 15%. So let's just make it clear. Let us make it in this form. 0.25. The R is 5.
5 minus 15. Okay.
15. All squared will give you what? When you square this, when you square it and multiply by that, that is 5 minus 0 minus 15 squared multiplied by 0.25 will give you what?
25.
25.
25.0. Yeah.
You square. So the result is what?
0.
0.
So the result is 0. Now for this is what?
25.
0.25.
0.25.
Okay, 25 minus 6.
5 minus
15. Raised to the power 2.
Minus
Yes.
15 to the power of 2.
That's 100. I mean, it should still be 25. 25.
25. So now the variance will be what?
50.
Variance is 50. %. So what will be the standard deviation?
Square root of 50.
So the square root of 50 will be what?
250.
No.
7.0.
0.071.
0.07.
Please explain. Oh, some of us don't know how we get it.
Just square root of 50 now.
I believe that square root sign. Let me go and show it to us again. Press it on your the sign again. This is it. Square root. See this in the square root. This one here. This one. Square root. So you put the value in on your calculator. So when you punch, the result will be what?
7.071.
0.071.
Fine. So we have another one. Everybody solve this. Let's see. Let's see. Where is this question now? I think this is from. Okay. Where is this question? Okay, let me just put down the question. Example. Let's say based on historical analysis. Based on historical analysis. It has been established. That probable returns on equity investments are so we can have the probability, we can have the return percentage. Probability 0.2, 0.5, and 0.3. And this, the return is 2%. This is 6, and this is 8. So with this now, can we compute the expected return, the variance, and the standard deviation? Yes, with this. Can you determine the expected return, the variance, and the standard deviation?
Yes.
So let's do that very fast. Just give me the figures, the answers. What is the R bar? What is the S bar? Whichever you want to refer to. So the R bar is what?
I have
5.8.
5.8.
5.8.
Yes, 5.8.
5.8.
Yes. So the
5.8.
variance, yes, 5.8. Then the variance will be what? The variance. Oh, we are not talking. I'm expecting response from Taiwo Karim. You tell me the variance. Aja, hope you are there.
Yes, I am.
So tell me the variance.
$13.22.
The variance. You can check that again, sir. That is now, if you have 5.8 as your mean, the difference between R and your R bar, you know, even when you have negative, you ignore that negative.
I have 4.36. So
Yes, 4.36.
Mine is
yes,
4.52.
So if you are not getting 4.36,
approximations.
check your workings again.
I have 4.37.
Yes, approximately.
I have 4.45.
Okay. Then the standard deviation will now be what?
2.088.
So this is it. For those of us that have not gotten it, this is it on the screen. So this is from SFM study pack.
So, sir, please, this answer now, explain it in relation to the question. How do we put it into our financial? What explain it? I can calculate this thing now, but I cannot explain what it is based on the risk and portfolio.
Yes, it means that we said risk is what? If you follow the class at the beginning.
I did.
Okay, fine. So that you measure risk using what? Standard deviation. Yes. So the more the value of your standard deviation, the more the risk. So when you are faced with choosing between two options, between two investments, and the standard deviation of one is less and the standard deviation of the other is high, and let's say their returns are the same, what will now form your basis of decision? You should go for the investment with lower risk. Yes.
Okay.
So the expected return from the investment is there for 5.8. I'm reading from what we have on the slide, with a standard deviation of 2.8%. So the statistical significance of the standard deviation depends on whether the variability in possible returns has a recognizable statistical distribution, such as the standard normal distribution. So in some questions, they will give you a standard, that is the risk, the expected risk in this particular, the standard in this particular industry. So by the time you solve and your result is higher than what it should be expected, your advice will now be, we shouldn't invest in this particular line of business because the risk is very high, depending on the company's organization objective. If the organization is interested in taking more risk, they can opt for it, because when you take more risk, it is expected that you get more returns. Yes, the higher the risk, the higher the return. So that is the expectation. But everybody have their own perception about risk. Yes, everybody have their own perception about risk. Some people are willing to take risks, some people are not willing. So depending on your organization policy in relation to risk. So there are certain things still we need to know. I was going through the pilot question forwarded to the yes, on ICANN site. Even some persons forwarded it to the group. I saw a question. I know some of you don't go through it. Me, I used to go through them. The pilot question on financial management. There is a question in one of the pilot questions. The examiner was asking, what is security market line? Security market line. I don't know if anybody has seen that. What is capital market line? Nobody have come across that.
I think Silas said he has come across that with his thumbs up.
Okay. It's fine. I was
Sorry,
not
sir. I
looking.
don't know if I was muted. My colleague shared it with me, so I checked it, but I've not solved it. So I went through it.
Okay. All right. So let me see if I have the diagram here. Security market line. So the point is this. Okay, fine. Security market line sometimes can be termed as capital markets line. Capital market line. So looking at this security market line, I just want to talk about that, or capital market line. When you talk about the capital market line, is a pictorial representation of all the portfolios. The pictorial representation of all the portfolios that optimally combine risk and return. Yes, a graph showing the risk and return associated with each investment. So it is based, this risk is as measured in relation to standard deviation. So the capital market line is a theoretical concept that gives optimal combination of a risk-free asset and the market portfolio. So the capital market line is also in line with the efficient frontier. Yes, there is what we call the efficient frontier. The efficient frontier. The efficient frontier is a graph showing the perfect expectation of returns from investment. So the capital market line is a special case of capital allocation line where the risky portfolio is the market portfolio. Yes, the risky portfolio is the market portfolio. So from these points on the graph, on the slide, though we've not gotten to these points where we'll be talking about capital asset pricing model and the rest of it. But the point is this: we can see the market line moving upward from the left, right upward. It shows that when the risk-free is less. Now, what are risk-free securities? Risk-free.
Security that does not have any risk on it, abi?
Such
Yes,
as,
Government bond.
treasury bills. Government
yes,
treasury bills, yeah.
government
Yeah.
treasury bills. So, risk-free securities can see that the return is low because you are not taking high risk. You are just trying to be neutral. The return is low. But for securities with high risk, the return will be high. The market return will be high. So this concept of risk-free security market line is in relation to capital asset pricing model. And capital asset pricing model has a formula. It has a formula. And in that formula, you look at your risk-free, you look at your beta, you look at your market return. Let me see if I have that here. Yes, so this is the formula for the capital asset pricing model, where we have RF plus beta into the bracket of market return minus risk-free. So this formula can be used to determine cost of equity in another way. So some questions will combine CAPM and cost of capital together. So by the time you solve, you should now use this formula to determine your cost of equity. And this is CAPM formula, where you have risk-free plus beta into the bracket of market return plus what? Minus risk-free. So the difference between market return and risk-free can otherwise be referred to as a premium. Because in a question, they might not give you the value of, they might not give you market return, but see, they can just give you the premium. And in that case, you don't need to solve for this again. You just use that value and multiply by your beta value. Yes. Madam Victoria. Is she there?
Sir, is it me?
No. I'm not seeing the person talking, but the Victoria's voice is different from this. Yes. I detect everybody by their voice. Okay, she's not on this. It's not you, ma. She's not
I'm
on
on the
this.
call, sir.
Victoria, yes. So, you forwarded a question to me. Yes. So I said we've not got it to that point. So we are gradually getting there now. Yes. So the next thing I want us to do is to solve the question I forwarded. That will now take us to looking at two asset portfolio. In that question, we have two asset portfolio. We have two forms of securities, two forms of investment. So the question will expose us to more issues on portfolio theory. That is the question on Danieli. We have two security X and Y. So this is the question. That Danieli is considering investment in one or both of two securities, X and Y. And you are given the following information. Security X, possible rate of return. We have 30%, 25%, 20%. For Y, possible rate of return, 50, 30, 10. Then probability of occurrence is given. And the question, you are required to do what? You can open it on your WhatsApp platform. I think that one will be much more clear. This is not clear. The one I have here is not clear. That we should do what? We should calculate the expected return for each security separately and for a portfolio comprising of what? 60% of X, this is weight now, and 40% of what? Of Y. Assuming positive correlation between possible rate of return from the shares comprising the portfolio. And the B is that we are expected to calculate the expected risk of each security separately and of the portfolio defined above. For this purpose, the measure of risk may be taken as standard deviation of probable variances from the expected rate of return. So outline the objectives that is seen now. Outline the objectives of portfolio diversification and explain in general terms the risk on individual securities. Yes, the risk on individual securities may differ from that of the portfolio as a whole. So this is an exam question. So what are we going to do now? Somebody will say, I'm asking them. I know they want to tell us. So, having run through the question, can you come up with possible idea? Yes, possible idea in relation to the first part that we should calculate the expected return for each security separately. You should be able to do this. The expected return for each security separately.
So I think we need to start from maybe portfolio X. We determine the expected return for it. That is doing probability multiplied by return rate. Then solve for the variance for X. Then do for Y. So I'm not sure, but that's just what I'm thinking.
When you are writing it in the exam, don't tell the examiner you are not sure. You write what you are saying. Because in the exam, yes, that thing in your mind is what is correct. But by the time you are beginning to doubt yourself in the hall, you begin to allow fear to set in. So as you see the question, you analyze it. That thing that is coming to your mind, put it down. Yes, put it down. So now, the expected return, the expected return of the individual security, just as she has said, we'll pick each security one after the other. The security X, we determine the expected return. Then we go further to determine the variance. We go further to determine the standard deviation. The standard deviation. That is, the question says, calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y. Assuming positive correlation between possible rate of return on the shares comprising the portfolio. So the expected return, let's see what we can do now. Solution. So for security X now, let's see. Calculating the expected return. Calculating the expected return. Let me see, and standard deviation of securities X and Y. So for security X, now, we have the probabilities, we have the return. So the expected return, as we've solved earlier, will be what? The expected return. So for this, we're going to have probability. We can have our return here. So the expected return will be what? If probability is 0.3, the return is what? 30. Probability is 0.4, the return is what? 25. If probability is 0.3, the return is what? It's 20. Now the expected return will be what at this point? 0.3 multiplied by 30. You have what?
0.09.
Okay. 0.09, right? Is that the outcome? Don't have my calculator here, please.
Yes.
Okay, fine. So in percentage, it will be what?
9.
9%.
1%.
9%. 9%. You can see all these are in percentage, right? So let me place percentage here. So in percentage, it's 9%. For this, you have it as what?
0.1.
0.1.
1%. 1%.
And for this is what?
6%.
6%.
So overall, your X or R bar will be what?
25.
25. 25. So if you move further and you want to determine our standard deviation, what are we going to do? It will be R minus R bar. The R is what? The value of R computed is what? 25, right?
5%.
Yeah.
25 minus the value of R in the question is what? 30, right?
Yes.
And the result here will be what?
5%.
5.
We don't count the negative as anything here. It's converted to positive. So at this point, it will be what?
0.
It will
0.
be 0. And at this point, it will be what?
5.
5.
5. It will be 5. So I'm just trying to show it in case some persons don't get what we've been doing over time. Now, column to the right. You can still go further. When those your statistics, you can go further and say R minus R into the brackets. When you square both, you have it as what?
5 square.
25.
25.
So this will be what? 25. And this will be what? This will be 0. And this will be what?
25.
25.
Right. So this will now be what? P to the bracket of what? R minus R bar. You have what?
7.5.
Here we have 7.5. This
0.
is 0. And this is
7.5.
7.5. So your variance will now be what?
15%. 15%.
So the standard deviation will be what?
3.87.
3.87. So 3.87. That is the square root of this, of 15. We give you 3.87. 3.87. So the expected return, the question I want us to compute is what? Is this. This is for security X, and it is what? Is 25. Now, when you compute for security Y, what will be the expected return? For security Y, the expected return will be what? So,
30.
okay, the expected return is 30, fine. So this standard deviation is what? What is the interpretation of this standard deviation? 3.87.
Sorry, sir. How did you get the 3.87?
Square root of 15. Square root of 15. So this 3.87 now, what can you define it as? What is standard deviation?
Of security X or Y?
The standard deviation is the risk,
Left.
of the security. Do you understand? By the time you are investing, what level of risk are you taking? So the expected risk of security X is 3.87. is 3.87. That is the expected risk. Though we are jumping, we are already looking at. I just want us to complete the table instead of solving part of the table and coming back here again. The expected risk of each security separately. For security X, the expected risk will be what? 3.87. So the expected return will be what? 25 for security X. For security X. So now, when you take it further, for security Y, for security Y now, for security Y, it will be what? The probabilities are not same. It means they are not correlated. 0.6 is 0.2, and this is what? This is 50. This is what? 30, and this is 10.
10.
So the expected outcome here will be what?
10. 10.
10. This will be what?
18. 18.
This will be what? 2.
2.
Overall, this will be what?
30.
30. So this R minus R bar will give you what here?
20.
This will be 20, and this will be what?
0.
0, and this will be what?
20.
20. And the result here will be what? And you square 20,
400.
100, and this will be 0, and this will be
400.
400. And this will be what?
80.
Multiplied by 80, 0, and this will also be 80.
80.
So the variance will be what?
160.
The standard deviation will be what?
12.65.
12.65. 12.65. So now, if you are to advise
Security X.
based on what criteria?
Because
Based on
it
the
has a
level of
clear risk level of 3.87 as compared to Y of 12.65.
What of in terms of return?
In terms of return, security Y promises more return, but a higher risk.
So now your choice will now be based on your appetite to risk.
Okay, me, I'm risk averse, so I will do security X.
You don't like risk.
I don't like go too much.
You are Madam Chidimma.
If it's too risky, I'm not there. I'm off.
Because I know Chikodili might be interested in taking more risk.
Charge. I
Yes.
swear, you.
All right. So the question is asking us to calculate the expected return for each security, which we've done, and for a portfolio now. Now, you know when you
Because I have
combine.
a question. I have
All
a
right.
question. Sorry. In the exams, are we going to give our decision based on what we think, or there's a standard?
No, not based on what you think. The question will tell you what to do. The question will tell you that company XYZ is a risk averse this, is a risk.
Okay.
Yeah. So depending on the scenario, but when the question is silenced, you just solve and show your computations. where the question is telling you to advise based on this, then you advise. But where the question is silent about your advice, you solve and move on.
Okay.
So the question is asking us to calculate the expected return for each security separately, which we've done, and for a portfolio comprising. It means your portfolio is 100%. But in that portfolio, what is the proportion of X? What is the proportion of what? Y. The
Right.
proportion of X is what? 60%. The proportion of Y is what?
40%.
40%. So how do you calculate the return? The return of that portfolio.
Okay.
How do you calculate the return of that portfolio?
Okay. 60 or 100 times the portfolio.
The return on the portfolio. How do you compute it?
This is a two asset portfolio. So I see this formula that we are going to apply now.
This one for portfolio return.
Excuse me, sir, Mr. Tope, please, my network logged me out. Please, can you just help me scroll up a bit? I am that probability of X bar minus R, R bar minus R. So I'm not getting, okay. Okay, I think I'm correct. Okay. Okay, sir. Thank you. I'm correct. Thank you, sir.
Wow.
So the point is this, that we should calculate the portfolio return. We should calculate the portfolio return. To calculate the portfolio return,
Who's making that noise?
to calculate the portfolio return, we define WX to be what before now?
Wait.
We said the weight of the
Weight of the
weight or
weight,
proportion of
sir.
the amount spent on security X.
Fine. Weight. Now, when we compute the individual security, what was our return regarding X?
25.
Fine.
25.
Good. 25. Plus, for Y, what is the weight according to the question?
60%.
Why is 40%?
40%. When you compute the return for Y individually, what was your result?
30.
30%.
So you now solve. You can see the formula is just there looking at if it's one this thing. So what will be the return on the portfolio combined? The return on the
Okay.
portfolio combined will now be what?
That's 0.6 times 0.65 equals to 15%. 0.3 times 0.12 plus 15. 27%.
27%.
Yeah.
That is the combined return. 27%. 27%. 27%. Who is not getting 27? Portfolio return. So it is return on portfolio will be equal to what? The weight of X 0.6 multiplied by the return 25 plus the weight
Huh?
0.40 plus what? Plus 30. When you do this, your outcome will be what?
27.
27.
27. And you take it further. The question wants us to determine the risk of the portfolio. You know, you've determined the risk of the individual portfolio, right? Isn't it?
Yes, sir.
Those standard deviation, those variance, the risk they are the risk of the individual portfolio, individual securities rather. Now, for you to determine the risk of the portfolio, what are you going to do? The risk of the portfolio, what are you going to do?
Sorry,
That,
sir, please.
Sir?
Sorry, how did you get that 0.6? Sorry for taking you a little bit back.
Is in the question, sir. The weight.
Okay,
The weight.
okay. I get it now.
The weight. So now, to get the risk of the combined security, which is the portfolio, what will be the approach? What will be the approach now?
We are using that formula. We are applying the formula on what we have calculated so far.
Yes, that is, here's the formula now. This one, the risk, you can see, that is the square roots of all this analysis here will give us the risk of the portfolio, the risk of the portfolio. So calculating the portfolio risk, calculating the portfolio risk. Calculating the portfolio risk. So calculating the portfolio risk. We have the formula to be what? W what?
X squared
X squared.
and standard deviation of x squared too.
And the standard deviation.
Of x.
Yeah. It take me a long time to be writing all this. So based on our solution, our W is what?
Our W for x.
WX. WX is what?
60%.
60%. 0.6.
0.6. 0.60, right?
Yes, sir.
To the power of 2. To the power of 2. And also the standard deviation. Our standard deviation or our variance is what? Our variance now. Because we square our variance is
Okay,
what?
15%.
15.
15%.
Squared. Squared.
Wait.
Sorry, is there a minus there?
No minus yet. You have to multiply.
Okay.
Okay, square is in the question like WS square and variance squared. Hello, sir.
Yes, ma.
Okay, I mean please can you just let me see the formula so that I can just write it out? Okay.
So is that okay?
Yes, sir, it's fine. Thank you.
So this is for x plus
But sir, you're putting them in different forms. So you're putting 0.60 and 15. Does it rhyme?
you multiply 0.6 square by the result of 15 square, all these two in brackets plus.
I'm confused, sir.
Based on the formula,
Why are we doing 15
I don't
squared?
understand.
15 not in percentage and 60% and 15%. You're saying 0.60 square and 15 square again. It's not supposed to be 0.15. I don't know.
from what we
Oh,
solved, this is it.
okay.
So the 60%, the weight 0.6. Okay.
I
0.
know.
Okay, that's the 15% should be 0.15.
Yes.
Okay. Yes, can go in that 0.
Or we do 60, 15.
I get you. So then when you go further, you have it as what? Plus 0. What? Plus 0. 0.40 to the power of what? 2.
2 multiplied by 400.
To the power of 2. Multiplied by what?
0.16.
0.16.
Okay. Multiplied by 0.16. Okay, what I will do is let me, if these formula I've gone to pick is not allowing me to type further, not giving me room to type further. Let me just So everything is in bracket, is in square roots. So we have it in this form. That is 0.6 square,
Yes.
0.60 square multiplied by 0.5
0.5. Okay.
square
Yes.
then plus
0.40 square.
0.40 square multiplied by what?
0.40.
No,
Zero.
it should be 1.6.
Sorry.
1.6. Because it's
1.6.
160, so it's
160%.
1.6.
Can we say
Then
1.6?
please, what is the
Is it
percent?
no 16%?
160. No, 160.
Is
It's 160%.
So
1.60.
it's 160. So it's 160%, then 1.6.
1.6.
160 divided by 100, yes.
Yes. Okay.
So square then the results will now be what? Let's see, 0.4, 1.6. Then from the formula, this will be minus what?
0.4 minus 0.6.
-2.
Minus 2
You see it?
before the
And
bracket.
There is 2 before the bracket, okay. Ah,
you can help us coordinate your children, ma. I know it's weekend. It's a full home now. Don't worry, you still give them time now. So minus 2. WX is what?
0.60.
0.4.
0.60.
0.6.
Sorry, 0.6.
0.60. Now, the standard deviation is what?
15.
It's 3 point. What
7.
3.8?
Standard deviation. Okay. 3.87.
3.87.
3.87 multiplied by 3.87. The next is what?
0.4.
0.40.
0.4.
0.4 multiplied by what?
Right, 12.65.
12.65.
12.6. This 65.
Yeah.
Yes,
Right.
sir.
Yes,
65.
So the next is what? The correlation.
return.
Is there correlation? This point here, is there correlation between the two securities? Between the two securities. That is correlation coefficient between security X and Y. Correlation securities between security X and Y. How will you know if there is correlation? It is when their probability
The same.
are same. Yes, when their probability are same. So I said earlier on that when the given probabilities of two securities are different, the given probabilities when they are different, it means that there is no relationship between the two securities. So the value of R will be what? 0. The value of R will be 0. So regarding this now, if R is 0, the implication is that this whole value here will be what?
0.
Sir, sorry, I have a question.
All right, what is the question?
Okay, from the beginning of the formula, we used deviation, but after the two, why did we start using standard? Sorry, from the beginning of the formula, we used variance. So after the two, we used standard deviation. Please, can
Yes,
you elaborate?
yes, that is the definition of the formula. You look at the formula clearly. At the first part of the formula, we're looking at variance, variance, variance. This is it. You can see it. This is variance, variance. That is x squared. This is variance. So as we proceed further, we change to what? To standard deviation. Change to standard deviation because that point, we're trying to determine the covariance between both securities. So in following this deviation or this risk sign is not with the square root. It's not with the root rather. Yes, it's not raised to the power of 2. And that is why we're using standard deviation and not the variance as we have it at this point. So I don't know if that is fine. It's not a mix-up, it's the definition of the formula. So if correlation is 0, what will happen to this whole part of this formula?
0.
0.
Because 0 multiplied by all this will be what?
0.
All right. I can see you raising up your hand.
I want to ask about that correlation between X and Y for the two
Yes.
security. Is it going to be
Yes.
given to us in the question, or as we solve, we know that they are not related, they are not correlating? Or
Yes.
will it be given the question stating that they are not, they
It will
don't have
not be
any
stated.
relationship?
You will use your eagle eye to see it. This is it. The probability for X at this point is 0.3, right? For at this point is 0.4. At this point is 0.3. If we are to repeat same probability for Y, it shows they are correlated. It shows they are correlated. But where the probabilities of this value, X, is different from the probability of security, Y, it shows they are what? They are not correlated. They are not correlated. It shows it is negatively correlated. Yes, Mr. Williams.
So what if the other way around, the possible rate of return are the same, but the probability are different?
The possible rate of return are the same and the probabilities are different. Yes, if the returns are the same, it now shows that if the returns are the same, it now shows that the risk in relation to both securities varies, and your decision now will now be based on the fact that which security is having more risk. So in that case now, it shows that they are positively correlated. Positively correlated. So in that case, for you to determine R, it will now be covariance of X and Y divided by the standard deviation of X multiplied by standard deviation of Y. So I hope I have a question related to that. Then we'll see that, or I give it to you as an assignment. So we're going to check that. I'm going to forward a question related to that, whereby where R is expected to be used in that formula, what will now be, you are not going to solve for R. And how will you solve for R? It is covariance of X and Y divided by the standard deviation of X multiplied by standard deviation of Y. So talk more on that. Hope that is fine, sir.
Okay, but we need more clarification on that. So,
Yes,
by means of example.
yes, we'll get examples and show that. So now for this, if your R is 0, if the value of R is 0, what will happen to this part of this equation here?
Everything will be 0.
It will be 0
So the risk
automatically.
of the portfolio will now be what?
Risk free. Which is
0.37.
Zero point 0081 plus 0.41.
Okay. Then it will now be what?
Now be square root of 0.418.
Okay. Yes.
Then the square root will give you 0.647.
Okay.
That's
Yes.
64.7%. We will leave it like
Yeah, I got 0.608.
maybe approximation, but
Mine is 64.63%.
that's 0.647.
So the final answer is 0.647.
That's what I
Mine is
got.
0.646.
Same thing.
Yes. Who is getting this likewise?
Please, can I see the final answer of this one that we just solved? The portfolio risk. Okay. I'm not.
Okay,
Okay,
I
thank
have
you.
0.646 now.
Wait, I have an observation regarding this. Sorry, this what we've done now. Let me see.
Approximation error.
It's I'm just 1 minute. There is something I need to just clarify. Yes, something I need to clarify. This formula here, yes, this formula with x square. This is what? This is variance, right? This
Okay.
is this is variance, isn't it?
Yes.
Yes.
So we are not supposed to square this value again. Do you understand?
Mm.
This is variance already. This is variance. We are not supposed to square it. Do you get, please?
Yes,
Because
yes. Because
we're not
variance is
supposed,
already square.
yes, we're not supposed to square this value again. So
Okay.
please, let's do the correction. We're not supposed to square that value. This to the power of 2 here, no.
Okay.
Sorry about that, please. We're not supposed to square it.
But the 15 is not the value we got after we squared it. I think 15 is what we got before we now take it to the square root where we now get
No,
3.8.
no. We are talking about the square before the square root now. We did the square to get this value.
I don't understand.
The square you're
This
talking about is like saying 0.60
is,
square. We did it like that.
see it here. This square, you've already squared to get this value here. To get this value here. So that is what we're referring to. That you don't need to square.
Okay.
You don't need to
Okay, I've
square
seen it.
this value again.
Okay.
Yeah. So can we recompute so that
I'm finished. I'm finished.
Okay, bye.
now for those that have recomputed, the C part of the question want us to outline the objective of portfolio diversification. So to your own perception, what do you think are the objective of portfolio diversification? Just 1 minute, please. Excuse.
The objective I can say that is in order to share your risk so that if anything happens to one particular investment or one asset in one industry, it wouldn't affect everything you have. So one of the objectives is to share our risk across various industries so that an impact or effect in one will not affect everything.
He said you should hold on. He's coming. He said the moment.
Yes, I'm back. So talking about the third part of the question that outline the objectives of portfolio diversification and explain in general terms why the risk on individual security may differ from that of the portfolio as a whole. From that of the portfolio as a whole. So, Ma, you said something, though I didn't. I have to
I
attend to
got
some.
0.557.
Okay, 0.
Same here, 0.557.
0.557. Okay.
0.557.
Okay, 0.557. I think that should be fine now. 0 points. So these are computation here will now be what? This is this and this. So when we do this, 0 point what? 55
557.
557. So what are the objectives of portfolio diversification? Why portfolio diversification?
Okay, sorry. So I didn't even know you said we should pause them. So what I was explaining that time is that one of the objective, one of the reasons why we have to diversify our portfolio is that if there is any risk that one of it is being affected, the whole of our assets will not just go down the line. So if it affects one of the investments, others we might be able to have a higher return that might make us not really get the impact or effects of the previous or the first one that didn't do well. So I would say one of the objectives is in order not to put all our assets in one investment and we end up losing everything.
All right, yes. That is it. That is one of it. Yes. Anybody else want to add his or her voice to this?
Spreading our risk to other investment.
All right, ma. Yes. So the objective of portfolio diversification is to minimize portfolio risk in order to avoid a disastrous financial outcome by investing in securities that are negatively correlated or securities with no correlations. So the risk of individual securities may differ. Yes. So when you get this security, get this, get that, and pull them together, they help in enhancing your portfolio. So the risk of individual security is specific, whereas the portfolio risk account for the total risk. That is both systematic risk and unsystematic risk. So we've talked about systematic risk and unsystematic risk. The point is this: modern portfolio theory, we said, is premised on the assumption that a rational investor does not like risk. That is a rational investor. That is giving an individual investor a high level of risk will expect a high level of return. Once you're going into more risky projects, the return should also have a corresponding high return value. So when you look at what we've solved now, what we've solved in our calculation, security X has what? Has what level of risk? Has lower risk. Has lower risk. Yes, security X has a lower risk and return when you compare to security Y. Yes, when you compare to security Y with higher risk and return. So the risk associated with security Y is much higher than that of security X. So this investor will be much more better with diversification. So the benefit of diversification has reduced the risk of the portfolio as a whole. So when you compare the weight, the average, the proportion of security X and security Y. So the objective of portfolio diversification is just to mitigate risk, to reduce risk. And that is that. So let's take this question as an assignment. Is this question?
So please, can you just go back? I want to get a screenshot of the solvings.
Okay, I'll forward the slide to you.
All right, sir. Thank you.
Okay. The assignment is this. It's Juliet. Juliet.
Yes, sir.
Yes. Juliet has just won 100,000 naira. Juliet has just won 100,000 naira from Baba Ijebu. I know you don't play bets,
Ah, Jesus.
I don't play. Oh.
but you know Baba Ijebu.
Yes, sir.
So Juliet has just won 100,000 naira from Baba Ijebu. Says Baba Ijebu. From Baba Ijebu Lottery Limited. And has decided for the interim to place the money on two securities. Security X and Y, for a period of 1 year. 60,000 is to be placed on security X, and the balance on security Y. She has estimated returns that is cash flows to be received at the end of the year, plus project value at that time. And the probabilities of the three possible states as follows. as follows. Can have it as states, can have it as probability, can have it as predicted returns. Predicted returns at the end of the year. Predicted returns and at the end of the year. We have states, we have state A, we have state B, we have state C. Stated probability for this would be 0.3. For this now you can see that there is correlation, right? Already, because the same probability will apply for. So we have this to be 75 and this to be what? 45, 600. And we have this to be what? 73, 200. And this to be 47, 200. And this to be what? 67, 200. And this to be what? 48,000. You are requirements required
So I didn't get the last expected return for the other projects.
Hope you are there. So required calculates calculates the expected return, variance, and standard deviation of each security This is A, and B calculates the covariance. Calculate the covariance between the two securities. And the correlation coefficients. And C, what are returns? What are returns of our portfolio? Returns of our portfolio for each possible state. For each possible states. And what are those states? States A, B, and what? And C. And D, I think let me stop here. Let me stop here. If not, maybe to tomorrow. So this is a question that will enhance our understanding on what we've treated. Yes, even though I know the B, we didn't solve a question on it. We didn't touch it in the first question, but I'm leaving it there so that you do further readings. Yes, it's when you do further readings in addition to what we've discussed now, the understanding will remain with you. Yes, so I'll expect us to solve and send solutions. Let us see and correct ourselves to be much more better. So this is the question. And in the ICANN study pack, they didn't talk much about, I think it's about 4 or 5 pages for this topic, portfolio. Yeah, so the next